Today, we're going to be going through an overview of provisions that relate to this massive new piece of legislation that passed at the end of last year. We're going to be recording today's webinar, and we will make it available within the next few days through social media, and we also expect to post it on the Jones Day and DHG Healthcare websites. Next slide, please. Today's webinar is the first in a three-part series. We want to give you different perspectives on the law. Today we're going to do an overview, trying to cover the provisions that affect nonprofit hospitals and health systems most directly. And then on March 14th, we're going to take a deeper dive into the unrelated business income tax provisions and provisions that affect compensation and benefits. On April 11th, we'll have the third in our series, where we'll focus on mergers, acquisitions, and other transactions. We know that nonprofit hospitals and healthcare systems are involved in any number of different transactions, joint ventures. They have for-profit subsidiaries and affiliates. They contract with for-profit entities like physician groups. And so the many changes that were made in the law that go beyond nonprofit organizations will also be relevant. And across the three webinars, we'll also be keeping track of new developments coming out of IRS and Treasury, and we'll be on the lookout for the Joint Committee on Taxation's Blue Book explaining the new law for any insights or further developments that come from those sources. We will also send all of the slides from today's presentation to all who have registered after the program ends today. If time allows at the end, we will take questions. You're welcome at any time to contact any of us who are presenting today with your questions following the webinar. Next slide, please. Well, this new law is formally known as Public Law 115-97. It was signed into law on December 22nd, 2017. It moved with extraordinary speed through Congress. The law was first introduced in the House Ways and Means Committee on November the 2nd, meaning that there was only about a 7-week time span from when we first saw legislation to when it was signed into law. It is commonly known as the Tax Cuts and Jobs Act. That was its name through most of the process, though that title was actually stricken at the very end by action of the Senate parliamentarian operating under the special rules of the Senate, particularly the Byrd Rule, because the title didn't have budgetary effect. But I think you will continue to find for a long time to come that commentary about this law will refer to it as the Tax Cuts and Jobs Act, or the TCJA. The changes for the nonprofit sector made by the law are more limited than the changes that it makes for individuals and for businesses. There are profound changes to the taxation of individuals and businesses. There were any number of provisions affecting nonprofits that were in play across that very short, accelerated legislative period, a number of which did not actually become law, and keeping track of what was included in the final legislation and what dropped by the wayside is a worthwhile endeavor, given that some of the things that did not become law would have been rather significant. We will today focus on the changes for nonprofit hospitals and health systems. In particular, those changes affect unrelated business income tax, compensation and fringe benefits, and the structuring of transactions. Now I'd like to cede the floor to Amy Bibby to take it from here.
Thank you, Kathy. So we will dive into the first topic that Kathy mentioned regarding unrelated business income. This is certainly one of the more substantial provisions that affect the tax-exempt sector. The main provision requires a siloing of various business activities, really having the effect of not allowing offsets of gains of one activity to be offset with a loss of another activity. And so we have an effect where there will be presumably greater taxable income being reported by the tax-exempt sector overall. Also, net operating losses are to be computed for each line of business and must be carried forward only with respect to that business. Historically, we have been able to utilize a net operating loss created in one business line to offset taxable income in another business line. So that is a substantial change. Net operating losses created going forward will only be able to offset gains with respect to that exact activity. We saw hints of this in a 2014 tax reform proposal. We also saw some hint of this in the fairly recent college and university compliance project, and of course it has made its way into tax law. This change is effective for tax years beginning after December 31st, 2017. So that means for fiscal years beginning in 2018, whether that's a January 1, 18 fiscal year begin, or perhaps a June 1 or a October 1 of 18 year. So we will see this in our upcoming 2018 tax year. Net operating losses arising in tax years beginning before this provision, however, can still be used to offset unrelated business income going forward. So our old NOLs, in effect, have a grandfathering effect of being able to be utilized going forward against those profitable activities. So in essence, we don't have to go back and figure out what activities were attributed to that loss and reserve them in the same way we have to going forward. On the next slide, we'll go through an example of, and this is a very simplified example, but it's a good illustration of how this is going to work going forward. So in this example, we have two business lines, one being parking that has a loss of $1,000, the other a laundry activity that has income of $4,000. Of course, in our prior tax law, we would have been able to net those together to $3,000, pay tax on $3,000. Going forward, our UBIT for this year would be $4,000. If we had an NOL carry forward up through 2017, we would be able to offset $2,000 of that income with a final UBTI of $2,000 going forward. Again, that net operating loss, regardless of where that past net operating loss, where it was generated, can be used to offset our income going forward. So on the next slide, we'll see some open questions and concerns, and this is kind of the format we'll use throughout the presentation today and in future presentations. Hopefully with some clarity as the months go by from a regulatory perspective that Kathy mentioned. But there are certainly some questions that arise from what we have now. And one of those is how to identify or distinguish between separate lines of business. To what extent activities can be grouped together if they are similar in nature. That is certainly an area that we would anticipate further dialogue and correspondence. Another area is in the area of passive investments, and to what extent passive activities could be treated as a single business line, or must they be looked at that underlying business activity of what that investment is for a determination of what that business, that trader business is. So again, that is certainly an outstanding question. Certainly we would anticipate some further dialogue on that area. Certainly be aware, estimated tax payments, because of the speed in which this was enacted, as Kathy mentioned, we certainly have a need to consider estimated tax payments, and certainly some questions around penalties and eliminating, to the extent we can, any penalties for not paying in under these new provisions. We don't yet have a new Form 990T, so we're not sure how this is going to really look once they put it on the form. We would certainly anticipate some substantial changes to the form, but we're not sure yet when that form is going to be made available. And lastly, certainly some outstanding questions around applying pre-2018 NOLs if there's any change in control. And I would anticipate some further dialogue, perhaps in subsequent webinars here as we learn and hear more from a regulatory standpoint, but to what extent those pre-affiliation losses can be used in a post-affiliation scenario. So on the next slide, we're going to transition over into some changes in the rules around net operating losses. And these changes affect both the not-for-profit and certainly have implications to the for-profit sector. So the substantial changes with net operating losses, we've talked about the siloing, and that really is a tax-exempt specific provision where we have to separate and silo our net operating losses from our loss activities going forward. But from a general standpoint, net operating loss carrybacks are eliminated. However, carry forwards are now allowed indefinitely, so there is no expiration date to net operating losses. The net operating loss deduction, however, can only reduce your taxable income from unrelated business income at a rate of 80%. And so if we go back to our prior example of having $4,000 in that tax year of income, and in our example, if we change the fact to we had $4,000 or more of net operating loss, we would be limited to only being able to offset that taxable income by 80% or $3,200, and then paying tax on the remaining 20% or $800. And so, again, this really has a substantial effect on planning around net operating losses and really unrelated business income in that tax beginning for 2018. So although we get to grandfather those NOLs going forward, we have the 80% limit. And again, just note that net operating loss applies separately for each trade or business, and except that NOLs for years starting before 12/31/17 can still be used against our total, so that grandfathering effect. The effective date of our net operating loss rules are really the same as our taxable income rules, in that it's for tax years beginning after 12/31/17. So this is for tax years beginning January 1st of 18, for example, June 1 of 18, 10/1 of 18, etc. So on the next slide, let's talk about a few other areas of of unrelated business income, and this applies to Section 512. That really it's payments to that employers pay for qualified transportation benefits and also parking. And so this applies to things like bus passes, bicycle commuting reimbursements, and also parking for employees. And typically employers have been able to reimburse or pay for that benefit and also deduct as a business expense the cost of those expenditures. That was a change that affected the taxable sector, and so the comparable or the complement to that provision in the for-profit sector was to require those same payments that are no longer deductible to be picked up as unrelated business income in the tax-exempt sector. There is a kind of a hanging cross-reference that is outstanding right now with athletic facilities. Athletic facilities were included in one version, didn't make it to the end, and right now that UBIT comparable still remains in the final bill. So we'll have to, that's certainly something that we would anticipate getting cleaned up in future guidance. There is a shift here in the effective date. The effective date for these employee fringe benefit related items are effective for amounts paid or incurred after 12/31/17. So this follows the more traditional employment tax calendar year going forward. And on the next slide, we'll dive into a few open questions and concerns around these provisions. And one is related to an outstanding kind of question: when a qualified transportation benefit is offered through a cafeteria plan, is UBTI still triggered? Parking and transit accounts are certainly authorized under Section 132 to provide for that pre-tax reimbursement, and so is that tax still triggered pursuant to this change? We certainly would be anticipating a correction around the athletic facilities. Again, that's a provision that did not make it through in the for-profit sector, so they still get the deduction. And so again, we would anticipate that to be a clarification that in fact is not required to be picked up as UBTI in the tax-exempt sector. And then lastly, when it comes to these employee fringe benefits that are required to be picked up as taxable income, the requirement around estimated tax, this has a unique feel to it in that it is not part of UBTI. It's part of UBTI. It's not part of a separate excise tax. So, whether penalties and interest for failure to pay on an estimated tax cycle would certainly also be an outstanding kind of issue that we would hope to learn more about. And so with that, I'm going to turn it over to Jerry to lead us through a discussion on the excise tax.
Thank you, Amy. Hello, everyone. We've been telling folks for years that the excise tax on excess benefits does not apply to the organization itself. That is still true. However, exempt organizations are now subject to a different excise tax on high-end comp, whether or not those compensation packages result in an excess benefit. Section 4960 adds an excise tax on compensation above $1 million for a group of covered employees, as well as for their excess parachute payments. The intent may have been to mirror the treatment for certain for-profit companies on the taxable side. Section 162M generally limits deductibility of comp above $1 million for covered employees, including the CEO, CFO, and the other top three highest paid employees of a publicly traded corporation. That limitation does not apply to for-profits that are not publicly traded. So instead of leveling the playing field, this provision actually puts many exempt healthcare organizations at a competitive disadvantage from a tax perspective vis-a-vis corporate entities on the taxable side with whom they compete for talent. The new excise tax applies to any remuneration paid to a covered employee by an applicable tax-exempt organization. The organizations covered include anyone exempt under 501A, so a tax-exempt hospital, HMO, as well as governmental entities. The tax also applies at the entity level. So if you set up a new exempt organization, it would have its own set of covered employees. If the new entity is disregarded, such as a single-member LLC, there would still be one set of covered employees for the entire enterprise. The tax that applies is equal to 21% of the comp above $1 million paid during the taxable year to any covered employee, which would be the 5 highest compensated employees for the current tax year, and anyone who was a covered employee in a prior tax year beginning after December 31, 2016. Next slide, please. Remuneration includes a broad range of compensation, includes anything that would constitute wages for tax withholding purposes. And it also includes amounts that have been vested under a non-qualified plan, for example, a non-qualified deferred compensation arrangement that is no longer subject to a substantial risk of forfeiture. Wages also includes payment in kind as well as in cash for services. There's also a 21% excise tax, as I mentioned, on excess parachute payments. Parachute payments are payments triggered by separation from employment, typically with a change in control of the employer. And an excess parachute payment is the amount by which that payment, the present value of that payment, equals or exceeds 3 times the base amount. And the base amount is annualized compensation included in the covered employee's gross income for the prior 5 taxable years before separation from employment. So that this is something that's likely to be triggered in healthcare, if at all, in large acquisitions. There are some exceptions to the excise tax. First, any Roth IRA contributions that the employee designated as being included in gross income would not count. Also, payments to a licensed medical professional for the performance of medical or veterinary services by that professional would not count. Parachute payments also do not include payments under a qualified retirement plan or a simplified employee pension plan, a SEP, simple retirement account, tax-deferred annuities, or eligible deferred comp plans. The remuneration that's covered by the new tax also would include any amounts paid by the exempt organization with respect to employment by a related organization for services provided by the same employee. And for this purpose, related organization would include any organization that controls, is controlled by, or is under common control with the applicable tax-exempt organization. If the remuneration is paid by more than one employer, the liability for the tax is apportioned based on the relative remuneration paid by each of them. So if you have 3 employers, each paying a third, then they would each pay 1/3 of the tax. There is also a provision in the statute for Treasury to develop anti-abuse regulations that would prevent avoiding the excise tax, such as through performing services as someone other than an employee, for example, as an independent contractor, or through a pass-through entity or other entity in an attempt to avoid the tax. The new tax is effective for tax years beginning after December 31, 2017. Next slide, please. The IRS recently updated its priority guidance plan to include a provision to develop regulations on certain aspects of the new 21% excise tax. There are a number of questions that hopefully will be addressed in that guidance, if not clarified sooner in the Blue Book. The first question has to do with how we determine how much compensation counts towards the threshold and how much is subject to tax. The exempt organizations may or may not be on the same tax year as the employees. Employees are all calendar year taxpayers as individuals, whereas the organization may be on a fiscal year basis. The same disconnect was an issue for years on Form 990 for reporting compensation. The way that was handled is to look at compensation from the W-2 for the calendar year in which that ended in the organization's tax year. So if you have a June 30 year end, you used compensation paid through December 31 of the prior year. The tax legislation, however, refers to the excise tax applying based on the taxable year of the organization. So we need to see how the IRS will reconcile that. Will it still be based on the most recent W-2? Will there be some allocation required for organizations that are on a fiscal year basis? The statute is also silent on what happens when a covered employee moves from one organization to a related organization in terms of whether they will still be a covered employee at the new organization. That may be picked up in the anti-abuse rules or otherwise clarified in the Blue Book or forthcoming IRS guidance. The exception for medical directors requires some clarification from the IRS, for example, on how to define medical services for this purpose, but also to address situations where a physician may be providing both medical and other services, and how will the compensation be allocated between those services. For example, serving as the VPMA of a hospital and also providing clinical services 1 day a week. There are also technical details to be addressed around how and when the tax will be paid. Presumably it would be on Form 4720, which is how a variety of excise taxes are paid currently. Those forms will need to be revised or the instructions clarified to include the new excise tax. The IRS also has to struggle internally with how to enforce this provision against organizations that do not file a 990, including governmental healthcare organizations. And given the new excise tax, we also may experience some increased aggressiveness by the IRS on audit in terms of how workers are classified, particularly how to classify medical professionals. And with that, I will turn it back over to Kathy for the next slide.
Thank you, Jerry. Now we're going to turn to some provisions that affect individual taxation but have an effect on healthcare more broadly. The first is the repeal of the individual mandate. This is Section 5000 Cap A of the Internal Revenue Code. It was enacted as part of the Affordable Care Act in 2010, and it was upheld as a constitutional exercise of the taxing power in the Supreme Court decision NFIB versus Sebelius in 2012. The new tax law didn't repeal the entire provision. Rather, it took the rate of penalty down to $0. It is a permanent provision, but the text of Section 5000 Cap A remains in the code. It includes a number of definitions, most especially the definition of minimum essential coverage that continue to be needed for other parts of the Affordable Care Act that remain in effect, like the premium tax credit and the employer mandate. The repeal is effective for months beginning after December 31, 2018. So the individual mandate remains in effect, and the possibility of accruing a penalty remains for this calendar year. There are information reporting requirements that apply to employers who have to report on whether or not they've offered coverage to full-time employees, and if they're self-insured, also have to report on who has taken coverage amongst their employees and their spouses and dependents. Those information reporting requirements remain in effect, so hospitals with their large workforces will need to continue to prepare and file Forms 1095-C, and if they're self-insured employers, they will also have to continue reporting on the coverage provided through that self-insured plan. There has been some discussion about potentially repealing the employer mandate as recently as this week. And the current administration, when they issued their budget on Monday, continue to talk about repealing and replacing the Affordable Care Act more broadly. They're looking to enacting in place of the Affordable Care Act legislation that was introduced by Senators Graham and Cassidy last year, which would move to more of a block grant approach, giving block grants to states to see what they would like to do to enhance and expand access to coverage. Not at all clear that any of those things will move forward this year. The Senate Majority Leader, Senator McConnell, has said that he is not inclined to take up repealing and replacing the Affordable Care Act during this calendar year. As a result of repealing the individual mandate at the federal level, there will be certain states that will look at what needs to be done in their perspective to reinforce the individual health insurance market. Massachusetts has an individual mandate that was enacted before the Affordable Care Act that remains on the books and will remain in effect. Other states may look at either enacting their own state-level individual mandate or enacting other kinds of provisions to shore up the individual market. It remains the case that approximately half of the American public gets their coverage through employers. That doesn't appear to be changing very much. And the individual insurance market is covering less than 10% of the American public. Nevertheless, a significant number of people in any given year will move in or out of the individual market, so the uncertainty about the future of the economic stability of the individual health insurance market may have repercussions for nonprofit hospitals and healthcare systems. Also, at the time that the legislation was enacted with this repeal included, the projection from the Congressional Budget Office was that approximately 13 million people would lose coverage in the over the course of about the first 5 years or so. The reduction in the number of people with insurance could also have repercussions for hospitals and health systems that continue to operate emergency rooms and therefore to serve as places where anyone can get access to care where they have a medically emergent condition, irrespective of their ability to pay. No one can say precisely how this is going to play out, but it is a factor that will continue to be watched. Next slide, please. Another provision which principally affects individuals but is having repercussions for nonprofit hospitals and healthcare systems is a change to the tax treatment of moving expenses. Prior to the enactment of the new law, individuals could take a deduction for moving expenses, for moving their household goods and for the travel and lodging involved in moving if they were going a certain distance, a minimum distance or longer away from their current residence. And if an employer paid or reimbursed moving expenses for employees who were beginning employment with the employer and were moving more than 50 miles away from their existing principal residence, those reimbursements could be excluded from income and also therefore not subject to employment tax. As a result of the new tax law, both the deduction and the exclusion have been removed from the law. The effective date on the exclusion is comparable to the effective date on eliminating the deduction, so the exclusion is no longer available for taxable years beginning after December 31, 2017. Any number of hospitals and health systems work hard to recruit medical professionals, often physicians, maybe scientific researchers, other kinds of medical skill sets that they need to operate and to take good care of the patients in their community and cover the different range of medical needs that those patients may have. Having lost the ability to reimburse those expenses and provide the new employee with a tax-free benefit, those hospitals and health systems are looking at the need to consider the tax consequence if they reimburse for those expenses. Nothing prohibits them from continuing to do so, but that reimbursement will create a tax cost for the employee. To leave the employee whole, those employers would need to gross up the employee. Furthermore, the reimbursement and the gross up will be considered wages subject to employment tax. So this will add to the cost of recruiting new employees when they need to make a move, and reimbursement of moving expenses is important to attracting them to the new hospital or health system. Next slide, please. Wage withholding. We know that hospitals and health systems are large employers with large workforces. The new tax law significantly changed individual taxation. It changed the brackets. It nearly doubled the standard deduction. It eliminated any number of itemized deductions. And the projection is that while prior to the enactment of the new law, approximately 70% of taxpayers took the standard deduction and did not itemize, the projection is that that's going to go up close to 90%, leaving only 10% of the public itemizing. When an employee starts work, they fill out a withholding certificate on IRS Form W-4 and inform the employer of the number of withholding allowances that they are claiming, and the employer will then set up the payroll to withhold income tax in accordance with what the employee has reported. Unless the IRS has provided the employer with a lock-in letter specifying the number of allowances that may be given to the employee's W-4 will control. The employee can also change that W-4 in the course of employment if their circumstances change and they want to change their withholding. The worksheet that helped employees figure out how many withholding allowances to claim was heavily based on the size of their family, because under the law, prior to December 22nd, 2017, they were allowed personal exemptions based on the number of dependents that they might have. Personal exemptions have been eliminated, and as a result, the existing W-4 is not necessarily helpful in allowing employees to figure out how much withholding they want in order to be in a position where they don't owe penalties for being under-withheld, but where they're not over-withheld either. The IRS has issued new withholding tables that reflect the new rate structure, and they continue to work off of the number of withholding allowances that employees have claimed. They've told employers to continue using the W-4s that they have on file for employees and to continue issuing the existing W-4 to new employees coming on board while the IRS works on developing a revised and new W-4 that can work with the amended tax code. They have informed employers that they must use the new withholding tables this month. Originally, they said that those new tables had to be used by February 15th, which would be tomorrow, but they then gave some more time and have told employers they have to be used no later than February 28th. The IRS is also working on its online withholding calculator that individuals can use to try and determine what the right number of withholding allowances is for their personal circumstances. Employers should expect that once the new W-4 becomes available and the new withholding calculator, they may be receiving any number of new W-4s or amended W-4s from employees asking for changes in withholding. They may also get questions from employees asking about how to change their withholding so that they can take advantage of tax cuts where they're available. Employers are usually very conscientious in trying to recognize that they are not tax advisors for their employees and that they should not be providing tax advice on individual employee circumstances. Nevertheless, they can expect that employees who are trying to deal with this and wrestle with all of these changes and figure out what it means for them will no doubt turn to them with some number of questions, and they'll want to be prepared for how they can politely provide information, perhaps from the IRS website or other sources, that will not put the employer in the position of becoming a tax advisor. There's no further information about precisely when that W-4 and the new withholding calculator will be available, but the IRS does have a page on its website where it is compiling all of the news releases, pieces of guidance, and other information that it's putting out publicly specifically about the Tax Cuts and Jobs Act, which provides one-stop shopping for seeing anything that has been newly released. Next slide, please. The medical expense deduction is available to individuals who have very significant medical expenses. The deductible amount is now, in the wake of the new tax law, for expenses in excess of 7.5% of adjusted gross income. The Affordable Care Act had taken that threshold up from 7.5% to 10%. The new tax law has taken it back down again. For a while, there was, as part of the legislative process, there was a proposal to repeal the medical expense deduction, but it did survive in the legislative process and remains available to individuals who are itemizing. The alternative minimum tax also remains in effect for individuals. The medical expense deduction is still allowed in offsetting income and computing alternative minimum tax. This change with respect to the medical expense deduction is effective for tax years beginning after December 31, 2017. This could be quite significant for patients of hospitals and health systems who are experiencing extraordinary medical expenses. At least there is still some amount of tax relief available to them. Next slide, please. This provision affects, for the most part, taxable entities rather than tax-exempt nonprofits, but as many hospitals and health systems will have for-profit subsidiaries or affiliates, it is certainly worth noting. For many years, the IRS, under the Internal Revenue Code, has denied a deduction to taxpayers. They can't claim a business deduction for amounts paid as fines or penalties. But when a taxpayer would enter into a settlement with the government, perhaps settling a False Claims Act case or some other kind of healthcare fraud and abuse investigation, it was not always entirely clear how much of any settlement payment was considered a fine or penalty and how much was restitution or repayment of some sort. This caused some ongoing enforcement challenges for the IRS in determining precisely what level of deduction should or should not be available. Congress has now changed the law so that if you are a business taxpayer, taxable taxpayer, looking to take a business expense deduction for a settlement payment, no deduction will be available for any amount that's paid or incurred to the government or at the direction of the government in relation to a violation of law or an investigation or inquiry by the government of a potential violation unless the amount that is being paid is either restitution or a payment to come into compliance with the law, and that amount, the amount that is going to be considered restitution or payment to come into compliance, is specifically identified in a written agreement with the government. So it will no longer be possible for the taxpayer to unilaterally take the position that a portion of the settlement payment is deductible and is not a fine or penalty. They will have to come into agreement with the government and record it in writing, which will add a new dimension to settlement negotiations. It does not apply if the government is not a party to the suit and if the court then orders payment. The government entities that are receiving these payments, which would be not only the federal government but potentially state or local government entities if they're involved in some kind of an investigation of a violation, the government entity will have to report to the IRS on the payments received so that the IRS will have information on what those payments are and the portions that should or should not be deductible. This limitation is effective for amounts paid on or after December 22nd, 2017. This is another item that appeared on the updated IRS and Treasury guidance plan that was issued last week, indicating that they plan to issue guidance on this provision by June 30. That's their goal and their objective. And part of the guidance will be about these government reports that will have to be made. They'll probably be on something like a Form 1098, not unlike the information returns that we all get if we're paying mortgage interest and the bank is reporting on those interest payments. It's entirely possible that tax-exempt hospitals and healthcare providers will start finding that they receive these reports, and the reports like these are being sent to the IRS if they enter into settlements with the government. That may be a bit confusing since if they are tax-exempt, they have no interest in claiming a deduction, and this provision shouldn't have a direct effect on them. All remains to be seen in how the guidance will play out on that information reporting requirement. Now, back to Jerry for some more discussion of other provisions. Jerry?
Thank you, Kathy. One other change that the IRS has to deal with is the new deduction for qualified business income under Section 199 Cap A. The new deduction applies to taxpayers other than corporations, and it allows them to deduct 20% of qualified business income from each trade or business conducted as a pass-through, so a partnership, limited liability company, or as a sole proprietorship. The qualified business income deduction also has some limits. It only applies for individuals in specified services if they meet the income limitation. The income limitation is $157,000 for single filers or $315,000 for joint filers in terms of gross taxable income. The statute defines specified services as including health, consulting, and other fields where the business relies on reputation of one or more employees. It remains to be seen how the IRS will define consulting and the catch-all for other services. The conference report does explain that the Treasury regulations in another context for Section 448 do provide some guidance on the meaning of consulting services, limiting it to the provision of advice and counsel, and not including other services such as brokerage services or economically similar services. The statute provides no further specific guidance beyond referencing facts and circumstances, and so it remains to be seen how the consulting definition will apply to various healthcare businesses. Next slide, please. The qualified business income deduction for other than corporations applies beginning after December 31, tax years beginning after December 31, 2017. The transactional areas where this may come up include population health management businesses or staffing companies, where the individuals on the other side may seek to restructure the arrangement to take advantage of the new deduction. It also may vary from one scenario to the next, whether the new deduction is more attractive than the lower 21% corporate tax rate. Next slide, please. The last area I want to talk about before handing it back to Amy is tax-exempt bonds. And although this is not welcome news, it is better than the original proposal in the House bill. As originally proposed, the House bill would have completely eliminated qualified 501c3 bond financing going forward for new issues. The final legislation kept the provision for new money financing and allowing current refundings, but ended the ability to advance refund qualified 501c3 bonds on a tax-exempt basis. And advance refunding would be if you issue bonds to fund the eventual defeasance of the bond issue and redemption of the bonds more than 90 days prior to the redemption date. And you may have seen a flood of bond issues or been involved in bond issues trying to beat the end of the year because of the original anticipated changes and even the limitation on advance refundings that ended up in the final legislation. AICPA has requested transition rules. There is no reference to transition rules in the statute itself, and we'll need to see whether the IRS will be accommodating or whether they will conclude that it's an issue that needs to be addressed in the legislature. The new provision is effective for bonds issued after December 31, 2017. So any advance refunding bonds issued after that date would be done on a taxable basis. The new legislation also has two other types of financing restrictions that may be of limited effect for healthcare organizations, both tax credit bonds, which is a type of bond that offers the holder a federal tax credit instead of the ability to exclude interest from income, and direct pay bonds, such as the Build America bonds, may no longer be issued after December 31, 2017. And with that, I will turn it back to Amy for the last couple of slides.
Wonderful. Thank you, Jerry. We will round out the discussion today talking about a few donor-related provisions, as many tax-exempt organizations, especially in the healthcare sector, do have, an aspect of charitable contributions, especially through our foundations coming in the door. We have a lot of change, as has been mentioned, in the individual sector that will certainly affect our tax-exempt charitable giving. One of these provisions is around the adjusted gross income limitation for cash contributions. That has increased for individuals from 50% to 60%. So those individuals will be able to have less of their cash charitable contributions limited for deduction. So that is certainly good news. The point that Kathy mentioned earlier around the doubling of our standard deduction, that really will have a substantial effect on those individuals who itemize. And so, whether charitable giving will take a effect or a toll based on that elimination of a deduction for many givers. The Council on Foundations has estimated right after the December 22nd date when this came out that they estimated charitable giving to decrease over the next decade between $16 and $24 billion. That's pretty substantial numbers, even in looking at 1.6 to 2.4 on an annual basis. Those are some pretty staggering numbers. So a few things here. Certainly, donors will certainly be very conscious of their increased standard deductions and that impact on them. There certainly is some discussion around bunching of contributions and some strategy by organizations that are very active in fundraising to really ensure that especially lower and middle income individuals who may not be itemizing can strategize around continue their giving and their philanthropic efforts. We've also seen an increase in dialogue around the need for a charitable organization to focus on the passions of giving and the reasons for giving to overcompensate or to compensate for the elimination in many situations of a deduction that folks will receive. Those individuals who are able to itemize, certainly some considerations around the giving vehicles to best provide a tax impact, whether that's more use of a donor-advised fund to, again, somewhat of a bunching concept there as well, to be able to effectuate similar contributions over multiple years with a one-year benefit of a larger deduction. So a lot of that definitely comes down to individual income tax planning, but certainly we believe we can expect some questions from donors as they are considering how this will affect them personally. On the next slide, we will talk about a few things because, as Kathy mentioned earlier, it's very interesting to see some of the provisions that did not get enacted. And a big one that Jerry just mentioned would have been the elimination of our tax exemption for interest on private activity bonds. that, really would have had a very substantial effect to our tax-exempt organizations. And so the fact that did not make it through was a very positive move there. And I'll not read through all of these. You can see these. The other substantial one that I think really speaks out, certainly got a lot of press, was the repeal of the Johnson Amendment that would have allowed C3s to engage in political campaign activity. And so that repeal did not happen. And so those types of political campaign activities are still prohibited by 501c3 organizations. Also, you'll see in there some information about royalties and some potential taxation there. That was kind of online. That didn't make it. Some of our, certainly in the healthcare sector, we have some royalty income from names, logos, trademarks, copyright. So no change in the exclusion there for royalty income as well. And as we conclude, just please, we'll take a few questions if we have any of those in the questions window. So please go ahead and pose those now. Really in conclusion, there's certainly a lot in the Healthcare Reform Act that certainly has implications to the hospital sector. We encourage you to participate in Part 2, where we will talk more about the specific exempt organization provisions, especially around UBIT and compensation. That's actually a month from today. That registration will be coming. And again, further updates and further details as we expect some momentum there. And then followed by Part 3 on April the 11th, right out a month later, regarding mergers and acquisitions, other transactions that really span beyond the tax-exempt sector and affect us all from a for-profit perspective and how we relate to those communities. So again, lots of good content coming there, and I hope you all can attend. I'm going to pause. Do we have any questions? Donna, if you can help us navigate any questions, I think we have a few minutes.
I can see here, Amy, that we have one question about the 21% excise tax that Jerry was describing. And when wages are paid by a related taxable organization, how are they handled for purposes of the 49, 60, 21% excise tax? Jerry, do you have any thoughts about this one? I think a lot would depend upon whether this individual is getting multiple W-2s or a single W-2 with a common paymaster. Any thoughts about what happens if some of the wages come from a related taxable entity?
Kathy, I think that's a good thought. We would have to look at the W-2 and the common paymaster rules. Also, if the entity is on the payroll of another organization, related organization, but is in fact providing services for the exempt organization, I suspect there's a good chance that the IRS will view that in the regulations or other guidance as being subject to the tax. Otherwise, it could create a huge loophole that I don't think Congress really intended.
And isn't it the case currently that in reporting compensation in the 990, both in Part 7 and on Schedule J, compensation paid by related organizations also has to be included? And would we think that that might be a good starting point, or hope that the IRS would start from that approach, which is familiar to exempt organizations, in figuring out how this would work?
Yeah, exactly, Kathy, which is the same reason we look to the 990 right now, is where the IRS may come out on whether compensation needs to be allocated for exempt organizations that are on a fiscal year basis, whether it needs to be allocated from one year to the next, or whether that would also be determined on a calendar year basis, as in with the 990.
Mm-hmm. Great.
Any more questions, Donna, that you've seen come through?
that was the only one I've seen.
All right.
Great. Well, certainly please feel free to reach out. We encourage questions and commentary. Our contact information here is on the last slide, so certainly encourage that after today's webinar. Thank you, Kathy and Jerry. Thank you, Donna, for helping us navigate the technology. And thank you for everyone that attended, and we are certainly looking forward to having you attend Part 2 and 3. Have a great day.